Precious metals continue to drive commodity markets. Gold is holding on to its gains, maintaining its relevance. Silver remains on the watch list for many investors. But opportunities abound in other sectors as well, with the likes of oil and copper showing meaningful signs of life. All of this and much more on this episode of the Commodity Exchange, including a very special segment on platinum. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities, whether you are an investor or just want to learn more about this topic. This podcast is for you. I'm Mubin Tahir, Director Macroeconomics and Thematic Research at WisdomTree.
I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at WisdomTree.
So Nitesh, we have lots of interesting news in the world of commodities. How about we start with something that's very topical right now, oil. And it's interesting because normally when there is an expectation that demand for oil might go down, you expect balancing forces to come into effect. And the biggest balancing force is OPEC, the organization of petroleum exporting countries, and you expect them to cut supply, to turn the taps off, to offset the effect from low demand. So demand goes down, supply goes down, price generally remains in equilibrium. That's the theory, that's the idea. But recently, since the trade war uncertainty, everyone's been talking about the prospect of lower demand, whether you read reports from the International Energy Agency, the Energy Information Administration in the US, whatever the source of such forecasts may be, everyone seems to be talking about the prospect of lower oil demand in the year ahead. But OPEC seems to be increasing supply. So what's going on here?
Well, Bean, you're right. It is quite perplexing. And it can be explained a little bit about looking at the market structure of oil. OPEC, the Organization of Petroleum Exporting Countries, and its partner countries control about 45% of global production. And their policy decisions matter. Now, yes, historically, they have been an agency for balancing market supply. So when supply looks tight and demand looks very strong, they've been increasing supply, and when demand looks weak, they've been doing the reverse, reducing supply. But it looks like the behavior indicates that they are changing strategy. Now, to be clear, OPEC hasn't announced that they're changing strategy in any shape or form, but their behavior over the last few months really does indicate that they're changing. Now, what has inspired that change? Well, they have been in production restraint for a number of years now. They've been holding back a large proportion of production, close to 6 million barrels per day of production. They've been against their aggregate potential. They've been holding off against the market. In particular, a subgroup of 8 of the OPEC and their partner countries have been reducing production by more than 2.2 million barrels of a kind of a voluntary restraint. And they're in the process of unwinding that restraint. They'd announced that a while ago, that they'll be unwinding it. But they were going to unwind it at a fairly measured pace of something like 138,000 barrels per day of production per month of increases, which would have been, a multi-year process to unwind that restraint. However, over the last 3 months, they have increased by, they've announced increases of 411,000 barrels per day of increase per month. So they've done that for May, June, and on Saturday they announced that they'll be doing the same for July. So that is a much larger increase than what was initially scheduled, and that is somewhat perplexing, right? Given that weaker demand that you mentioned. Now, there may be a a mixture of reasons why they are increasing that level of production. The first is the US is experiencing an inflation problem because of higher tariffs. Mechanically, you have higher higher levels of prices when you increase levies on imports, tariffs. And President Trump has been keen to keep inflation under check and has been applying pressure on OPEC countries uh, to reduce prices. And OPEC countries are keen to do deals with Trump and the Trump administration, and so have been somewhat willing to appease him. Um, so last month, when Trump was visiting various Middle Eastern countries, Saudi Arabia, UAE, all countries part of the OPEC group, there was lots of deals to be done. So that seems to be working for these OPEC nations. Um, Another reason for unwinding some of this restraint is that some of the OPEC countries haven't been good at keeping to their quotas. And countries like Saudi Arabia, which, are like the de facto head and de facto uh, uh, rule keeper within the OPEC group, have been unpleased with with that progress, and it seeks to punish some of these countries that haven't been complying with quotas. And Saudi Arabia has certainly a lot of spare capacity, whereas some of the countries that haven't been keeping to quota have very little capacity. So if Saudi Arabia raises production and it will be able to keep that extra production, whereas the countries that have been flouting these quotas won't be able to actually increase and won't be able to benefit from these moves. And thirdly, the next main reason is that during this period of production restraint, OPEC has given up a lot of market share to other producers like the US, Brazil, Guyana. And while we thought, last year that OPEC would probably play the long game, knowing that some of these other producers will run short on supply if they keep producing at really elevated levels. It does seem that though these OPEC nations are coming under financial difficulties from these the lower prices that come from really high production levels and weakening demand, and they seek to redress this. So, winning back some of that market share is part of what these OPEC countries are doing. And for Saudi Arabia, look, there's the maths make sense for it, right? Producing 8 million barrels of production at at $60 a barrel, is the same as producing 6 million barrels per day at $80 a barrel, right? The maths work out to be the same. So using that kind of logic, they are just targeting that sort of that lower price with a higher volume. Now, so why today have prices not, so today we're recording on the 2nd of June, just after the OPEC announcement on Saturday, the 31st of May. Why are oil prices trading a little bit higher? Well, I think that the market was worried that OPEC would announce an even larger supply increase, but it's restraining to that 411,000 barrels per day, in line with what they were increased in both May and June, is a bit of a relief to the markets, and therefore we are seeing a little bit of a relief rally at the moment.
That's a great overview of why OPEC might be motivated to increase, certainly, Nitesh, and yeah, I was certainly in the camp of the people who were a bit perplexed why prices were going up, because we know that prices can be very sensitive to the actions of OPEC, and generally when OPEC is cutting, that's price positive, and when they're increasing supply, that's price negative. But we've seen prices reacting positively, and of course in markets it's not about what happens, but it's all about what happens relative to what was expected. And certainly, like you said, in this case, markets were expecting an even larger increase. Do you think we will still see volatility, I suppose, in that lower range? I think last time in our last episode we said we may just see oil trading perhaps in that lower, in a lower range compared to the last couple of years. But do you think that still holds? We might see oil prices remain range bound, even if it's a slightly lower range compared to the last couple of years, given what OPEC is now putting into effect?
Yeah, I think volatility is here to stay. But I think yes, once again, it'll be range bound. Um, Now, some of the sources of that volatility, one, OPEC hasn't really revealed its cards, right? It hasn't said we've had an explicit change in policy. So each month we're still guessing a little bit in terms of what they're going to be doing, because they're diverting from what they advertise as a schedule. But not only that, we've got the backdrop of the trade wars, and every week we go through, you know, a bit of escalation and a bit of de-escalation, right? It seems to be the pattern that we've gone through the last few weeks, and I won't imagine the next few weeks and months being that much different. Um, we've got the US also in discussions with Iran on a nuclear pact. And once again, we could see that escalate to de escalate pattern there as well. Sanctions may be tightened on Iran in the short term to get them to the negotiating table to have these discussions before we get some sort of outcome, and we could see some de-escalation. So escalation will take prices higher because those sanctions will tighten up supply, and de-escalation will likely to take those prices lower. Also, for example, last week we saw U.S. administration renew Chevron's license for oil production in Venezuela, but in a very tight and narrow way. It's been prohibited from exporting any oil, for example. So that may have come as a little bit of a disappointment to some in the market that were expecting some export of that oil. So that's act for tightening. But once again, this remains quite a fluid situation, and I think policy may change things in the near future. So I do think that range bound but quite volatile prices are the sort of the flavor of the oil markets for the foreseeable future. But what I will be watching out for in the oil markets is how is curve structure changing. And I think that's really important because we've become accustomed to most of the oil futures curve, both in Brent and WTI, being in backwardation over the last few years, but a lot of that backwardation is eroding. And if you look at the curves today, we're seeing just the backwardation sort of just lasts for a year or so before it goes into contango, and that contango is steepening at that latter part of the curve. So it does indicate that there's near-term tightness, but longer-term looseness in oil supply, and at some point that looseness could come more towards that front of the curve as well, potentially taking the curve into contango throughout. So that's something key to watch out for in the oil markets.
Oil remains in a fluid situation. That's what I heard, Nitesh. And viewers, you heard it on the commodity exchange from Nitesh Shah himself. Oil remains in a fluid situation. Famous words, but of course, plenty to keep oil traders engaged, as Nitesh outlined. But speaking of trade wars and uncertainty, Nitesh, another sector which remains under that threat is, of course, industrial metals. The threat of tariffs has been hanging over copper for quite a while. We've seen it become a reality with the likes of aluminium and steel, and them getting uh, even higher in the last few days. But the threat is that maybe copper also comes within the fold of tariffs. Uh, we've seen that that has caused quite relatively higher levels of volatility even for copper standards lately. How do you see the tariff situation unfolding in the metals markets?
Yeah, so when it comes to tariffs from the US, there are these so-called reciprocal tariffs, and then you've got these sector-based tariffs. Now, copper has, and a few other metals have been specifically excluded from these reciprocal tariffs, but there are um, indications that there will be specific sector tariffs. And in the US, there is this so-called Section 232 study being undertaken to indicate copper's strategic um, use in the US, with the view to potentially put tariffs on copper. Given if it is designated a a special status, in the same way aluminium and steel have done in the past. Now, I guess what's spooking markets over the weekend and today is that President Trump announced that the tariffs on aluminium and steel will go up from 25% to 50%. So that's taking the steel and aluminium tariffs to a much higher level. And if these tariffs are being utilized in this way for those two metals, what could happen for copper? So right now, copper prices are rallying and rallying pretty hard. Um, with with COMEX copper, so the US based futures contract up over 4% today. Now there has been a quite sharp dislocation between US copper prices and London copper prices, so the London Metal Exchange prices over the last several months, and this latest announcement on aluminium and steel is a catalyst for that sort of sharpening of divergence between between the two contracts. But fundamentally, copper seems to be on a stronger footing in general. The a lot of miners are reducing their estimates for how much they're likely to produce this year. Um, and we saw Chile's copper authority, uh, Cochilco, and I'm sure I mispronounced the name, but Copper's, Chile's copper authority uh, revised down its production estimate for this year, but it's also increased its price assumption for this year as well. So that is in contrast with its previous forecast, where it was looking for much larger production levels during the course of this year, and it seems to fit a pattern of many agencies reducing their estimates for production. Also, last week we saw in the Democratic Republic of Congo, the DRC, one of its largest miners, the Kamoa Kakulka copper mine. It was affected by seismic activity, which caused which caused a flood within the mine, and it's likely that some of its mine production will be taken off. How much is uncertain, because we're getting contrasting messages from its various shareholders. But there is an indication that there is some damage there, and some production is likely to be taken offline. And once again, these unplanned production disruptions are helping copper prices rise. So while we still got robust demand, and we're seeing robust demand coming out from China in particular with its electrification agenda, supply does look quite constrained, helping copper prices rise.
Excellent. So, with that, Nitesh, let's turn our attention to one of our favorite topics, gold. And I saw something interesting recently, and it seems like under President Trump 2.0, it's all about acronyms. It was the Make America Great Again, the mega acronym. Then we had the Department of Government Efficiency, DOGE, and now another one doing the rounds in the financial industry is the taco trade. Uh, Trump always chickens out, and this was coined by someone I follow actually, Rob Armstrong from the Financial Times, who just said this jokingly on. In the work he does, he writes his Unhedged newsletter and he co-hosts the Unhedged podcast with Katie Martin. Great podcast, by the way. Uh, and then it became a thing, and a journalist apparently asked Trump about what he thought about the taco trade, and he was obviously very upset. And he said, "Look, this is not a term that he appreciates," but he said that these are negotiating tactics. Anyway, ultimately, the implication on markets is that if Trump always chickens out, or whether he pulls back on the scale at which he threatens those tariffs. We saw that with China. We saw that with um, various other things. We've seen him announce tariffs on foreign movies to protect Hollywood, then Europe, then threat of dismissing the chairman of the Federal Reserve. So a lot of very stern remarks are made and then they are pulled back. The implication as far as equity markets are concerned is that maybe equity markets are starting to say the taco trade tells us we no longer really need to worry about the worst case scenario. Like we've seen the fear index is now down again. The volatility index VIX is down. NASDAQ has pretty much recovered all its losses from earlier in the year. So at the end of May, we were basically flat. We're now marginally up for the year. So as far as equity markets are concerned, it seems like they're maybe moving ahead, moving on from the trade saga. But if we look at gold, gold is still high. Yes, it's not at its record high as we speak on the 2nd of June, but it's still maintaining its strength. Is gold seeing something that equity markets are missing, or are the other forces still at play? Like, is gold seeing something on the trade front, or is gold being supported by all the other forces that might still be very important in continuing to keep gold supported? What's your take?
Yeah, I think there's some amazing observations there. And on the taco trade, as we discussed earlier in this podcast, there is that escalate to de-escalate tactic, right? Come up with something really hard so that it can be negotiated, but it gets people to the negotiating table, right? Starting off with something weak could go under the headlines and be forgotten, but to start off with a hard bargaining position and then soften, at least gets people to the table and take things take the point very seriously and devote a lot of resource to it. And no, if once again, if equity markets now expect that, and equity markets tend to do a good job of um, putting things into an outlook, not just focusing on the the next day activity, but looking further down the line. If this is a repeated strategy, they may say, look, at the end of the day, things aren't ever going to be as bad as what they were on sort of an announcement of a certain policy. Then equity markets may start to sort of gather a lot of momentum, as we are seeing right now. But the problem is with all of this is they are negotiating tactics. There's nothing to guarantee any of this will ever work. And if you're stuck with an announcement that can't be negotiated away, then you are stuck with that policy that maybe um, was the unintended destination point, right? And it's, when it comes to things like tariffs, high tariffs are damaging not just to the country trying to import their goods into the US, but also damaging to the US as well. It's damaging to the US economy, generally speaking. And so, stuck with high levels of tariffs could be, a terrible mistake to be lumbered with. And so, gold is that insurance asset, right? So gold is still that asset that hedges against these worst case scenarios, these accidents potentially forming. So I believe a lot of investors are saying, look, well, we can see through the trade negotiation cycle, and therefore we think there'll be some nice growth opportunities here, but we need to hedge ourselves against the things going bad. And that's where gold is taking a really nice role in a lot of portfolios. But also, there's also the underlying concerns about, where currency will go in the US. If we get further dollar softening, that is quite supportive for gold. And so gold prices are responding to that. Gold is also responding to the fact that bond markets are a lot more volatile today than they have been in the past. And gold is getting a lot more sort of attraction as being that kind of that asset as the closest competitor to bonds. And once again, gold in a physically held format is with zero credit risk, and therefore has a lot of appeal there as well. So gold is getting a lot of support, and once again, with those 50% tariffs now on steel and aluminium. We don't know how long that will last, but gold was once again seen a little bit of a lift over the past week with that announcement.
I know, Nitesh, your gold model is very well received by investors. A great way to conceptualize all the forces at play. But how difficult or easy has it been to maintain a gold model in these times, and be able to predict what happens next?
Yeah, it is a challenge with so many things moving so quickly. Um, in particular, the bond market assumptions to put in the model, they're very difficult right now. We've seen a lot of volatility in bond prices and therefore yields, and knowing where they're going to go is hard, especially balancing the effect of short term. What short-term rates will do on things further down the curve. So will the Fed be forced to loosen rates and therefore have a dampening impact on 10-year rates further down versus what's happening with so-called perceived credit quality of U.S. treasuries, and thinking about debt downgrades, credit rating downgrades. That does put into sharper focus some of the higher debt levels in the US. US's willingness to continue to make all the coupon payments, etc. So that also potentially can take yields higher, right? When you get decreasing credit quality. So there's a lot of opposing forces on the bond market side. So that's one assumption that's quite complicated to assess in the model. But also some of the things that are outside of the model framework, which are becoming a bit more important these days, or I suspect are becoming a lot more important these days, namely central bank demand for gold. One of the reasons I don't have central bank demand in the model itself is because the model is calibrated on monthly data using data spanning several cycles. Unfortunately, I don't have that quality of data for central bank purchasing, because the monthly data that's reported to the IMF in under the International Financial Statistics generally is really underreported, and so putting that into model it becomes quite difficult. But if I recalibrate the model using quarterly data, I get a better picture of gold prices, but it's less useful for forecasting, right? So right now, the price, the actual price, gold price gains are a lot higher than the what my model is predicting, given all the known data that I have, and a large part of that is probably explained by elevated central bank buying. And once again, I'm skeptical of the quality of data that central banks are reporting. Um, Traditional big buyers of gold, like the Chinese central bank, the People's Bank of China, are only reporting relatively small amounts of gold purchases compared to what they were buying a couple of years ago, which looks a little suspicious. And I think the central bank demand is probably a little bit higher, and therefore accounts for why those prices have made such a divergence. Um, so yeah, right now it is quite challenging actually to replicate gold prices with the model. But thinking about the future, and the model is not just useful for explaining the past, but looking to the future. What the model does point towards is even with relatively small declines in bond yields, small depreciation of the dollar, um, inflation, moderating from today's levels, but maintaining sort of investor speculative positioning, so enthusiasm behind gold at fairly sort of moderated levels, or around long-term historic average levels, could take gold prices up by a significant portion, taking them to 3,750 by Q1 2026. So, all-time new highs are just around the corner once again, even with fairly constrained assumptions going into the model.
Excellent. So, Nitesh, before we close, I suppose we can talk a little bit about silver as well,
Yep.
gold's cousin, and we often talk about the gold to silver ratio. It still remains very high, around the 100 odd mark, which is much higher than historical averages. Now, there's nothing saying, there's no reason to say that, look, it has to come down to a certain level in a certain period of time, but you typically expect it to. Historically, it has. And when I think the last time it was at these levels was March 2020, when it went beyond 100. And then after that, we saw that period of sustained silver outperformance relative to gold. Uh, but if it's not happening very quickly, if it's not correcting very quickly, maybe that gives investors a bit more time to act and take their positions in silver if they are so inclined. How do you see this dynamic playing out? Do you see that ratio coming back down to historic levels? Do you have a view on how quickly might that happen?
Yeah, so I think getting back to long-term historic levels um, may be a bit of a stretch, because gold is performing stronger than silver for probably one reason, a few reasons, um, and they include the fact that it's a really strong geopolitical, financial market, and economic hedge instrument. Right, gold is somewhat separated from all of the metals for those reasons, and it has that superior edge on that front, and a lot of the gains in the precious metals um, sleeve are due to those pressure points. So gold probably should be priced, or that little bit higher, or its gains should be that little bit higher than silver for those reasons. But silver has really strong fundamentals on its own, And I do think that silver needs to catch up a little bit towards gold. So maybe sort of halving that difference, taking that gold silver ratio down to sort of there's sort of 90-80 marker. And silver's strong fundamentals include one that strong correlation to gold, but beyond that, its industrial demand is pretty strong, and a lot of that is due to electrification. Solar is using a lot of silver, and solar installations are on track to outpace prior installations. And on top of that, the amount of silver that goes into most applications, solar panel applications now, are generally higher per unit than they have been in the past. And that electrification train just remains on track. So I think the silver should be making at least a partial catch up. Now the time span is always difficult to forecast, but I already think that that catch up is overdue. So within the next few weeks and months, I do think that catch up should be gathering pace. And you've seen that in some of the other metal markets, and we'll talk a little bit about platinum later on in the podcast. But sometimes when tension is being put on a certain metal, it starts to gain that traction. Sometimes some phenomena are just overlooked, right? And I think that may be the case for silver. That catch-up potential is there, and it's just being overlooked at the moment. Platinum has been trading in a relatively tight range between $900 and $1,000 per ounce for most of this year, up until last week when it broke out to close to 1,100 per ounce. That coincided with London Platinum Week. Have investors rediscovered the metal? To explore what is driving platinum, we have Edward Struijk, Director of Research from World Platinum Investment Council, to join us today. So welcome, Edward. It's great to have you back on the show.
Thanks, Nitesh. Thank you for inviting me on. It's a total pleasure.
Yeah. So before we started recording, we were talking a little bit about Platinum Week last week. I assume it was a very busy week for you.
Yeah, it really was. I mean, there are 3 Platinum Weeks, if you like, every year. One's in London, which was last week. One is in Shanghai, which is coming up in the second week of July. And then there's one in New York in September. And they're big events where everyone in the industry kind of get together, and bearing in mind that these metals, platinum, palladium, and some of the sister PGMs, are used in a multitude of different downstream industries, as well as being investment products in their own right. It's when everyone gets together and kind of chats and gets to find out what's going on. And what I would say about this Platinum Week, perhaps in contrast to last year, is that actually it felt very upbeat. Everyone was quite excited. They thought, you've already referenced the platinum price. We saw it kind of come through in terms of the big increase in the platinum price we had during the week. And I mean, to be honest, that often happens during Platinum Week, but this time it feels a little bit different. We're seeing genuine market tightness in a lot of the leading indicators. So lease rates are at 12% plus your credit spread, which is really high. And you've got strong backwardation in the OTC market in London. So those 2 things in themselves suggest that there is tightness in the market, and that may translate into upside potential in pricing.
Yeah, no, it is great to hear, and it is nice to see that sort of the optimism. I mean, I think you've been discussing the tightness in platinum markets for a while, and we're likely to go into a 3rd consecutive year of supply deficits. I think in the past, even though these deficits were very likely, we saw those range trading prices. But as you say, there seems to be a little bit of change in sentiment at the moment. What do you think are the long-term implications of these sustained deficits on price stability and potentially investor behavior now that they're looking like they're here to stay for longer?
Well, I think there are probably two things to address in your question there. And the first is, we've obviously had 2 years previously of a deep deficit. We're in our third year now. Why has the price not reacted to those deficits previously? Is the first question. And to answer that, I think the platinum is such a rare metal, and it's produced in such small volumes that you can end up with sort of excess above ground stocks, and effectively that's what we've had that's been filling that deficit over the last couple of years, is those above ground stocks satisfying the market for its metal demands. But we're getting to a point now where by the end of this year, we estimate on our definition of above ground stocks, we're getting to barely 3 months of demand cover. And the kind of rule of thumb in commodity markets is once you get down below less than 6 months of demand cover, then that's when things begin to look a little bit tight. The problem for platinum is that our estimates of above ground stocks collectively are very difficult to come to hard and fast numbers. So a lot of it's in the eye of the beholder. But even for the people who might include sort of additional sources of material in their estimates, we're getting to really sort of skinny levels. And so ultimately, we would expect that to begin to translate into price action. And to a degree, if you look at, as I mentioned earlier, those lease rates, that's an indicator that there are tight market conditions. But equally, if you're a holder of those residual above ground stocks, and you can lend metal out at 15% or whatever the sort of ratio, the rate is, that's quite attractive. So you can lend metal out whilst retaining beneficial ownership of it and make really good returns. But that provides short-term liquidity to the market that sort of suppresses price action until those loans need to be closed out and the metal needs to be returned to the lenders.
So one of the things that has affected most commodities this year is geopolitical uncertainty, particularly around trade policy, and obviously we're focused on US tariffs on the rest of the world. How have those tariffs or potential tariffs reshaped platinum demand and investor strategies in the first quarter of this year? And obviously, we don't know where tariffs will go for the remainder of this year, but what are your guesses in terms of the uncertainty that is injected into the market in terms of demand for the rest of the year?
Well, it obviously has been quite significant in terms of the level of uncertainty. And in fact, actually, I kind of did a review of the research that we published year to date a couple of weeks ago, and realised that we'd never published more research than we have done this year. And our research has never been more out of date because everything has changed so quickly that it's quite hard to remain current with stuff. What I would say is there are probably three main areas in terms of platinum demand where tariffs may have an impact. So firstly, it's automotive demand, so demand for new vehicles. There is potentially jewellery demand, and there's potentially investment demand. So addressing these each in turn, for new vehicle demand, clearly, if you put tariffs on vehicle imports into the US, and the US only produces about 50% of its own vehicle requirements domestically, then that's going to increase prices for new vehicles. And there is a correlation factor between vehicle price and consumer demand. And our estimate, based upon historical analysis, has been that for every 1% increase in vehicle prices, you decrease demand for new vehicles by 0.5%. And that translates into reduced demand for platinum for catalytic converters in internal combustion engine vehicles. That's arguably factored into our estimates already. So we've reduced our forecast for for global demand for automotive demand for platinum by 50,000 ounces. And that reflects reduced production, actually primarily in Europe, for export into the US. In terms of jewelry demand, we actually think that most of the sort of high value jewelry or watches that might be produced in Europe and for US demand can be produced in the US instead. And so we've made limited changes there. In fact, actually, generally in terms of jewelry, we are kind of seeing quite a significant amount of upside potential globally. In terms of investment demand, we have reduced our North American numbers there. So a lot of bar and coin that was produced in Europe for export to the US on the bar side is now subject to tariffs. That used to be about 70% of the US investment market. And so there are ways around that, but it is likely to weigh on US demand for platinum bars in the short term. Until it's, again, it's another area where actually the US, in theory, domestically can satisfy its own needs. So I guess this is sort of playing into the sort of Trump administration's targets. A lot of that can be onshored into the US, and so will be satisfied domestically in the future. But right now, we're seeing that sort of short-term disruption that needs to be taken into account in forecast numbers. The other area where, as a final thing in terms of tariffs, where there's been a huge shift has been really in terms of sentiment. So prior to the confirmation of exactly what would be tariffs, for want of a better name, Liberation Day or whatever it was termed as, we saw a lot of fear in the market about, well, are our imports of platinum or palladium or other PGMs going to be tariffed in the future? And so that concern, before there was certainty, drove significant demand in the US to import metal ahead of its actual sort of the time when it was actually needed. So we've seen a huge shift in terms of metal flowing from Europe in particular, London mainly, into the US. And so that in a way has kind of accelerated, I think, the discovery of these tight market conditions, and the the fact that I mentioned earlier that the London market, the OTC market in London, has ended up in deep backwardation as a result of that. That's a temporary distortion, but I would argue that it actually has just accelerated the sort of discovery of these tight market conditions that we've been expecting for a while.
So another thing you highlight in your first quarter report is the strength in demand for platinum jewelry coming from China, not just jewelry, but also investment bars. Do you see this as a fundamental shift in sort of regional patterns, or is this a little bit more of a sort of tactical response to the really high gold prices that we've been seeing lately?
I think to be completely honest, I think it's a little bit of both. So the Chinese market is able to pivot extremely quickly. I mean, it's extraordinary actually how nimble businesses in China can be. And so what we've seen is these really high gold prices have resulted in significant reductions in demand for gold jewelry in China. So gold jewelry purchases were down 32% year on year in Q1. That's a huge drop, and it's a massive market, obviously, for gold. And the kind of fabricators and retailers in China have tried to react to this, some of them have, by pivoting away from gold to a degree and producing jewelry and other metals. And that may include platinum. Bear in mind, of course, there's a working capital benefit to them from doing this as well. With the massive increase in gold prices over the last couple of years, their working capital requirements have really exploded. And so switching into other metals just helps release some of that working capital, lower price metals. I think in terms of platinum, jewelry fabrication was up 26% year on year in Q1. The area where I'd be slightly cautious is to say, we can see the fabricators and retailers doing this. Is it translating into consumer demand? And the jury is possibly still out on that. My perspective is, as a consumer, that if you put something in front of people, if they're going out to buy jewelry, and you show them something, they're more likely to buy that than to go and hunt for something alternative to it. So I'm quietly optimistic that it will translate into genuine consumer demand. The product offering is increasingly good in terms of quality. Also bear in mind that in China, the jewelry market is a kind of quasi-investment type market where you've got this sort of 9995 high quality or 24 carats, if you like, platinum jewelry that's comparable to 24 karat gold, and people will buy it to wear, but also as a kind of a bit of an investment as well. And we're also seeing, in association with this, an increasing number of jewelers also stocking platinum investment products as bar and coin. in their salons, as they're termed, as well. So that kind of just reinforces the link between the two.
Wow. So platinum supply continues to face structural headwinds, especially from South Africa and North America. What role do you see recycling and secondary sources playing in bridging the supply gap in the years ahead?
Well, so if you look at the total supply landscape, it's about 7 million ounces a year, in contrast to demand that's about 8 million ounces. 5.7 million ounces of that 7 million ounces of supply is from raw supply, if you like, it's mining, and the rest is recycling. And in theory, recycling could help bridge the disconnect between total supply and total demand. The challenge is that recycling is quite sort of price elastic. So it's the one area where you don't really see recycling come through unless prices are supportive of people recovering catalytic converters from end-of-life vehicles, putting them into the recycling supply chain and recovering those metals. And that's not dependent just upon platinum alone. There are 3 platinum group metals that go into catalytic converters: platinum, palladium, and rhodium. And right now we're seeing very depressed pricing for palladium and rhodium. And whilst platinum's had a nice little pop over the last couple of weeks, it's still not that. It's still pretty depressed compared to history and compared to gold. So there isn't really an economic incentive right now, collectively across those 3 metals, for people to recycle. And so at the moment, whilst our kind of base case forecasts are for a fairly significant increase in recycling over the next couple of years, which is not enough to fill the supply-demand disconnect, we're continually pushing that estimate back, because every time, that's our kind of consensus, safe sort of view of things. But every time that we go and review our numbers and talk to the recyclers, they're just not seeing that raw material in their terminology, the spent catalytic converters, come through the system. So we have to continually push back that forecast of supply growth, and so we end up with continued and deeper deficits as a result.
Yeah. So maybe returning to where we started the conversation. We've got really strong fundamentals in the platinum markets and significant supply deficits. Up until recently, we saw just that range trading prices. How are you interpreting investor sentiment in this context? I know we've seen a nice pop out in prices from last week. Do you think that'll be sustained? And what do you think the mood is with investors in general?
Well, just as a kind of reminder, for the type of organisation we can't forecast prices. We can comment on what has actually happened. What I would say is that generally the kind of consensus view is that platinum is in deficit, and at some point you would expect the market to respond to that in terms of a price response. I think one of the challenges for investors is we've had these well-reported, quite deep, sustained deficits for a few years, and we haven't had the price response. And so, naturally that makes investors kind of question, well, are the numbers right? Is there really a deficit? Our view is that absolutely there is, and we're just seeing the effects of these above ground stocks that are sort of satisfying the market on a temporary basis, and that the price response will come at some point in the future. I think that the main challenges for people, is that now. And given that we've had a couple of years of deep deficits without a sustained price response, that's a perfectly reasonable question to ask. Is it now? We'll have to wait and see. I hope so.
Yeah, no, we certainly hope so as well. Otherwise, it makes analysis so difficult, right? When some things are in a deficit, you'd expect the supply and demand economics to be driving prices. Yeah. Otherwise, you have to find a brand new model for things.
It's commodity 101. I mean, this is not sustainable. But markets can prove you wrong when you're right for a really long period of time before you're shown to be right.
Well, it's been great having you on our show once again. And please do remind our audience, how can they follow your research? Where can they find it? And where do they go to when they want to learn more about platinum?
Thanks very much, Nitesh. So our website is platinuminvestment.com. You can find all of our research there. It's available for free. Most of it's produced by people who are far smarter than I am, and they're very well informed and good at producing insightful perspectives on the market.
Excellent. Thank you very much.
Excellent. Nothing is getting overlooked, certainly in commodity markets, as far as this podcast is concerned, Nitesh. And for our viewers, of course, all of that and more on the commodity exchange. But that's all that we have for you today. Thank you, everyone, for tuning in. And we hope you've enjoyed this episode. Before we close, I do need to state the following to clarify the views and opinions expressed in this podcast are those of WisdomTree and in this episode, the World Platinum Investment Council, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. And with that, if you do want to hear more from us, please subscribe on whichever platform you're using, and do take a moment to leave us a 5-star rating. You can also follow us on LinkedIn or X, both Nitesh Shah and myself, or follow WisdomTree on these platforms. And if you want to learn more about commodities, please do visit WisdomTree's website, where we have a wide range of research materials and insights. With that, we'll see you all next time.